Introduction to Consolidations, Chapter 9, Interim Acquisition. In all the previous examples, the control over the subsidiary was acquired at the beginning of the reporting period. In Chapter 9, we will look at the effect on the consolidation process if control over the subsidiary is acquired at a date during the reporting period. The following steps will primarily be affected by this scenario: your at-acquisition consolidation journal entry and the calculation of profit attributable to NCI. An interim acquisition of a subsidiary has the most significant effect on the consolidation process in the year of acquisition. You still need the at-acquisition equity of the subsidiary so that you can eliminate the common items, measure NCI and goodwill or gain from bargain purchase. But because your acquisition date is now during the reporting period, you might not immediately have all that information available on that date because the subsidiary's reporting period is on a different date and they would not necessarily have prepared financial statements at the date of acquisition. So to solve this problem, you need more calculations. So you can either get the subsidiary to prepare the financial statements at acquisition date, or what usually happens is you reconstruct the available information for the entire reporting period to calculate the required at acquisition date amounts. So an important step in this consolidation process is to identify the pre-acquisition and post-acquisition profit of the subsidiary in that year of acquisition. To help you visualize what is meant by an interim acquisition, have a look at this timeline. You have now the start of the reporting period, and I'm specifically talking about the subsidiary, and the end of the reporting period. But now your acquisition date is no longer at the start of the reporting period, but somewhere during this year. For purposes of consolidation, you still need the equity of the subsidiary at acquisition date so that it can eliminate. But what you typically have is the retained earnings of the subsidiary at the start of the year, and you can have the profit for the year. So to help you to get to the retained earnings at acquisition date, you need to reconstruct this information. You need to add to this opening balance retained earnings the profit of the subsidiary specifically relating to this pre-acquisition period. Because everything in the pre-acquisition period forms part of the equity of the subsidiary that's not allowed in the group, so it has to eliminate. From that, you can then deduct any dividends applicable to this portion of the reporting period, and that will then give you the retained earnings at acquisition date that you can eliminate for purposes of the at acquisition consolidation journal entry. When you then work with the since acquisition date period, this is now the only profit of the subsidiary that is allowed to be in the group for purposes of the consolidation process. From that timeline, it is evident that the profit of the subsidiary for the year needs to be split in a pre-acquisition and post-acquisition period. So you therefore have a new calculation that is added to the consolidation process to achieve that split. You will consider the individual income and expense items. Some may accrue on a day-to-day basis, but others might only arise at a specific date. Your judgment is required to do the split, but you will also be provided with sufficient information to allow you to split the profit of the subsidiary into these two periods. Something to look out for is something like a dividends Ordinary dividends are taken into account in the period in which the dividend was declared for purposes of calculating the equity of S. Your cumulative preference dividends, however, accrue on a time basis and are therefore allocated evenly during a reporting period.